The US economy has been showing signs of slow growth, but emerging markets could be set for a boost thanks to recent data releases and Federal Reserve cues. Data from the Atlanta Fed suggests that Q2 GDP growth in the US is expected to be around 1.4%, which is lower than previous estimates. This decrease in growth rate has led to speculation that the Fed might not raise interest rates as aggressively, potentially benefiting emerging assets. Additionally, a recent survey by the Institute for Supply Management, ISM, showed that business activity in the US slowed down in June, further supporting the notion of slower economic growth. The Federal Reserve's tone on inflation and interest rates has also been a catalyst for emerging market gains. In its latest statement, the Fed emphasized its commitment to a patient approach to monetary policy, which could lead to a more accommodative stance. This shift in tone has sparked optimism that emerging markets, which have historically been sensitive to changes in global interest rates, might benefit from a lower dollar and higher commodity prices. According to a report by Goldman Sachs, the US dollar index, DXY, has already declined by 2.5% since the Fed's last policy meeting, making it easier for emerging market exporters to compete globally. Furthermore, a recent survey by Bloomberg found that over 70% of emerging market economists expect their economies to grow faster than developed markets in the next quarter. However, not all is rosy for emerging markets. Some analysts argue that the benefits of a weaker US dollar are being offset by rising yields in developed economies, making it more expensive for emerging market borrowers to refinance their debt. Furthermore, a strong rebound in the US economy could lead to increased demand for commodities and higher interest rates, potentially weighing on emerging market assets. In terms of specific scenarios, one possible outcome is that emerging markets continue to outperform as investors seek higher yields and diversification. This could be driven by the expectation of lower interest rates and a weaker dollar, which would make it easier for emerging market companies to service their debt. Another scenario is that the Fed's dovish stance leads to a rotation into riskier assets, including emerging markets. Tactically, investors might look to buy into any pullbacks in emerging market currencies or equities with support levels around 0.72 for the Mexican peso and $1.15 for the Brazilian real. In terms of timing, a potential buying opportunity could arise if the Fed's next policy meeting in July does not deliver a hawkish surprise. The US data and Federal Reserve cues are setting the stage for emerging markets to shine, with many economists predicting that their economies will continue to grow at a faster pace than developed markets. As investors seek higher yields and diversification, emerging market assets could be poised for further gains. In terms of sector specific opportunities, investors might consider overweighting sectors that benefit from a weaker dollar and lower interest rates, such as commodities, consumer staples, and telecommunications. Conversely, sectors that are heavily exposed to the US economy, such as technology and finance, may underperform in the near term. Ultimately, the outcome will depend on how investors respond to the changing economic landscape. However, with emerging markets offering higher yields and diversification benefits, they could be an attractive option for investors seeking to ride out any potential market volatility.